Hello, my name is Jess Riley. I am the Director of Life Insurance Sales here at Insurance Agency Marketing Services. First off, I want to thank you all for joining us today. We've got a couple of different strategies I'd like to share with you that I know can help you increase your life insurance sales as we move into 2021. So I do appreciate you taking the time out of your day to review this presentation. We're going to go through some maximization strategies today. The thing that I want to tell you first and foremost on any of these types of strategies is if you have questions on what we cover, feel free to call us at any point and ask for any of the life insurance sales directors. More specifically, if you have some clients that you think would benefit from these types of strategies, we'd love to hear from you so we can help you get some designs put together as well. So in the essence of time, let's get started. Let's just jump right into it. So today we're going to cover some maximization strategies that we can utilize with life insurance. So we're going to consist today's presentation of three main sections. So we're going to cover a CD Max section. We're going to talk about a Roth Conversion Max section. And then we're also going to cover Return of Premium Max section. So let's get going with it today. We're going to start off with the CD Max concept. Now I know many of you are familiar with this idea. There are several different ways to structure this, and that's what I want to cover today. Some of them are a little more outside of the box than others, but all of these concepts are designed with your client in mind. So let's look at a little bit of context here around CDs. So certificates of deposits are safe vehicles, typically used for lump sums of money. We've seen scenarios over the years where interest rates have risen to make CDs more of an attractive vehicle. And with FDIC backing, they often appeal to consumers that are looking for guarantees with their money. These are folks who are conservative by nature. They do want some growth, but they like those guarantees, and that's why they purchase CDs. And there are a lot of clients out there that are still putting their money in these types of vehicles. What we do know about CDs is while they do offer some guarantees on the rates of return, they typically are not going to help with hedging against inflation, especially in the long term. Over time, the CD loses real value because the growth there is usually absorbed by inflation and taxes. And so what ends up happening with CD investors is they're essentially going broke safely. And we want to provide some solutions to remedy that. And that's what the CD Max concepts we'll talk about today are going to do. The CD Max strategy is going to counter that going broke safely pattern, because what we want to do is situate the customer between those low return products and the high risk products. So the big growth products are typically going to be risky. The really safe products typically provide very low returns. And we know we've got some places we can put them in between that will provide a benefit for the client. So for the case studies that we're going to look at on the CD Max concept today, we're going to use June. June is a 65-year-old female. She's in good health, no tobacco use. We're going to use a 22% tax bracket here. And again, we're being very generous with the CD rate. We're going to assume that it's 2.5%. Now, I haven't looked at CD rates in the last week or two, but I think, again, that is being pretty aggressive as far as the rate. But we do that to show you that even if you do have a strong performing CD rate, we can beat it with several different strategies. So let's get right to it. So the first scenario would be June wants some income, but also like to leave the value of that CD to her heirs if possible. So what does that look like? If you look on the left-hand side here, you can see that we have a $300,000 CD that we purchased. Her pre-tax income from this CD is going to be $7,500. Now, we did assume that June is in a 22% tax bracket. So just doing rough math there, that's going to put about $5,850 in her pocket after taxes. And again, we'll leave the value of that CD to her heirs when she passes away. The first solution that we would propose is something that can generate that same sort of leverage on the wealth transfer, but also increase the amount of money that June takes home. So what we could propose here is placing that $300,000 into an immediate annuity. And that immediate annuity is going to kick out a pre-tax income for June of $17,168. So we take the exclusion ratio and taxes into account, that'll net her about $16,611. Now again, That's all good and well, but we want to make sure $300,000 is left to her heirs. So we're going to peel off $5,505 of that SPIA income, and we're going to purchase a lapse protection universal life policy. This policy is no frills, it's nothing fancy. It is a guaranteed death benefit for life worth $300,000. And so what that does is that secures the wealth transfer piece in a tax-favored fashion. But we are also now increasing her after-tax income from $5,850 all the way up to $11,050 per year. So very, very easy to implement. Benefits June in a variety of ways. Most importantly, passing on that $300,000 and putting more annual income in her pocket. So that would be the first iteration of the CD Max that we could consider. But you run into some scenarios where a client might say, well, that's great, but I'm tying up my whole $300,000 if I use this strategy. What happens if I need some of that money for an emergency? Well, we've got some solutions for that scenario as well. And there are two ways that we would potentially look at this. The first one, we can use an annual pay structure to fund the life insurance policy. And that's what we want to review quickly here today. So what we're going to do, we want to make sure that she is still receiving at least the same net amount of income that she's receiving from that CD purchase. So to do that, we could take $105,000, a little north of that, and purchase an immediate annuity. And that is going to generate $5,850 of post-tax income for June. We are still going to use that same life insurance policy that has an annual premium of $5,505 to purchase that $300,000 death benefit that goes income tax free to her heirs. That has a price tag of $99,493. What we have done though is we've cleared up some funds for her. We have now freed up $94,726. Again, in this scenario, remember, June liked the concept but wanted more liquidity. So in this scenario, the after-tax income in her pocket may be a little lower, but she has nearly $95,000 that she can use as she sees fit, or just to kind of have as that security blanket in case of emergency. The second iteration of this would be using a single premium life insurance policy instead of that full pay type policy. So again, same amount of money goes into that immediate annuity to generate the after-tax income of $5,850. Then we're going to peel off $122,432 and we're going to purchase that same product, but we're going to do it in a single pay instead of an annual pay of $5,500. And so that'll leave us with a paid up life insurance policy. Death benefit will be $300,000, so her heirs are taken care of. So that's going to free up $71,787 for her. So again, the liquidity concern is going to be handled. That's going to make sure that she's got the income that she needs, the life insurance protection for her heirs, and then liquidity. So whether you go this route or you go the annual pay route, either way is going to provide leverage. And as you can see, either way is going to provide a better benefit than just parking that money in the CD and leaving it. So the last option that we would look at is, what if June likes the concepts that we're showing, but she's expressed some concerns about liquidity for chronic illness? So in that scenario, we may look at doing something a little bit different. Baltimore Life has a great single premium whole life product. So we have simplified underwriting here. So June does not have to jump through hoops, do blood, exams, urine, all of those things. We can get this through without any of that. And the policy does include accelerated benefits for chronic illness, which is addressing one of her major concerns. So how does this structure work? Again, we are never going to put June in a scenario where she is receiving less income than she would have been receiving from the CD. So we're going to peel off money for that immediate annuity. And then we're going to take $165,000 in this scenario and put it into the Baltimore Life single premium product. You'll notice that this premium amount is higher than the last strategy we looked at where we just bought the $300,000 GUL. You do have to remember that product was fully underwritten and did not include the chronic illness benefits that we are now providing for June. So we have taken $165,000 into the Baltimore Life policy. And again, everybody is taken care of. So we've got the same net income for June that she was receiving from the CD. We've got that life insurance protection for her heirs. We've left $29,000 and some change liquid for her in case she needs it, but we have added that chronic illness benefit. So if June does have a long-term care need or a chronic illness need, she is able to accelerate some of that death benefit on the Baltimore Life policy. Again, all of these max scenarios on the CD side are designed with the client in mind. They are, of course, going to help you as the advisor make multiple sales, but everything we've shown here has provided much more leverage on that $300,000 than June could ever get with any certificate of deposit. And that's really what we want to make sure we're getting across today. Conservative investors do have options that are much better than CDs, and we can help you design those type of cases. So one thing I would mention is with these immediate annuity rates, we know that they change. These rates are based on the numbers the time I was building this presentation, so they could vary slightly, but they're all going to be very close to what we have illustrated here in our concepts. So that takes care of the CD Max portion of our presentation. Let's move on to the Roth Conversion Max. So the context around the Roth conversion, we know that most of us are not subject to federal estate tax with the way the exemption levels stand today. But that does not mean that some of the assets that we pass on are not going to be subject to some sort of tax. And for a lot of us, IRAs and qualified funds can be some of the biggest pools of money that are left behind when we are gone. So when we look at IRAs and qualified funds, how do they pass on? So if we're passing these on to non-spouse beneficiaries, the account has to be liquidated in full within 10 years of death. So the old stretch IRA or the multi-generational IRA concept is no longer available to us. So the funds coming from those IRAs are going to be taxable to the beneficiary receiving them at that beneficiary's income tax rate. Qualified funds are not going to have a cost basis because we have not paid any tax on those monies yet. And that typically means that the IRA account that we pass on is going to be fully taxable to those non-spousal beneficiaries. So when we look at the changes that came into play in regards to the stretch IRA and multi-gen IRA, the inability to use those concepts has affected the qualified accounts and IRAs, not as much on the Roth side though, because the Roth distributions are generally received income tax free. But when we look at most folks in America, most of us have more of our retirement funds in the qualified type accounts than we do in Roths. And the reason for that's very simple, because there is a cost to contributing to that Roth IRA right now, and that's current taxation. Now we can have conversations on whether that thought process makes a lot of sense or not, but the bottom line is that's how a lot of folks are saving for retirement right now. And so there's a ton of opportunity out there for us to go help them improve their situation, make sure that more money is being passed on to their heirs and less taxes are being collected by the government. So what the strategy we can look at here is providing life insurance on the IRA or qualified account holder's life. And the death benefit we're going to utilize here is equivalent to what we think the income tax liability would be on the spouse if they were to convert that IRA to a Roth. And this is after the primary IRA account holder's death, of course. So we're going to show this on the next slide kind of in a graphic form. But what we're showing to illustrate, or what we want to illustrate here, is not only will the Roth IRA grow tax-free during the survivor's lifetime, but then on top of that, we're going to have an additional 10 years of growth after that surviving spouse's death, before those monies have to be distributed to their heirs, still, again, on a tax-free basis. So there's a lot of leverage we can provide here. Now, let's look at this thing in action. So for this scenario, we're going to assume that dad is the IRA holder. Of course, mom is the primary beneficiary of that IRA. And in their planning, dad and mom bought a life insurance policy on dad's life. Death benefit, again, is designed to offset the taxes for mom when she converts that IRA into a Roth. And so dad passes away, mom gets the IRA funds and also the life insurance proceeds. Mom now wants to convert that IRA to a Roth, which we know is going to incur some taxes. But no, not to worry here, because we have the life insurance benefits to help offset those taxes. And so now mom has successfully converted to a Roth. She's paid the taxes on the conversion. Now she has an account where she is getting tax-deferred growth, and tax-free income. And maybe best of all for her, when she passes away, she's able to pass this on to her kids in an income tax-free status. And again, one thing to note about this, as you can see in the red at the bottom, is this does not have to be for spousal beneficiaries only. This structure also can work for non-spousal beneficiaries and has a ton of power. The opportunity for you here is obviously the life insurance sale, and that's what all of these opportunities are. Everything I'm showing you is designed to create more life insurance sales for you while helping your clients with their tax situations. If you have any questions on this Roth conversion, please feel free to give us a call. We're going to move on now to the next section, which is called the Return of Premium Max. This one is really unique. We get a lot of interest from advisors and agents out in the field when I go over this with them. So I wanted to make sure and include that for us here. When we get into our later years, so we're approaching retirement or in retirement, we have a lot of needs and concerns, but three of the biggest that we see are a need for life insurance coverage. So again, we want to make sure that our final expenses are taken care of, that any outstanding debts we have are taken care of, and we just don't want to burden our loved ones with anything we may have left behind financially. A second need is for chronic illness coverage. Again, we know that 2/3 of us at some point in our lives are going to need some sort of long-term care or chronic illness support. And so that's something that's top of mind for a lot of folks in these age brackets. And then also, of course, we need income. If we're not working any longer and we're on a fixed income, we need to really make sure that we're maximizing the income that we get, because every dollar is important. So the Return of Premium Max strategy is going to help us address all these things under one roof. A lot of advisors will go to clients and try to address each of these concerns on a one-on-one basis. So maybe 2 or 3 different solutions for all these problems. And we're proposing that you can take care of all of these solutions all under one roof. And that is the Return of Premium Max strategy that we're discussing today. So again, this strategy is going to be a great fit for individuals that do have a decreasing need for insurance as they age. And the structure is going to look something like this. We're going to pay premiums for 10 years. We're going to wait for 10 years. And then starting in that 21st year, we're going to start getting our money back out of the policy. Now, the policy is going to maintain permanent life insurance protection. It is a guaranteed universal life. So these things are guaranteed to be in the contract. This is not a current assumption or an indexed UL type structure. So everything we show in here is going to leave a guaranteed death benefit and is going to have a level guaranteed premium and a guaranteed return of premium. So very, very powerful and very unique. So the scenario we want to look at here is a gentleman named Hank. You see him on the left-hand side there. Hank seems like a happy guy, wants to get his planning in place. And right now he has a need for $1 million of coverage. He knows that that need is going to decrease as his kids grow up, get out on their own, as he gets mortgages paid down and other debts and things of that nature. But also Hank, has a concern about making sure he has chronic illness covered. And so we're going to propose the Return of Premium Max strategy to Hank. Now what Hank is going to do in this strategy is he's going to pay an annual premium of $28,000 a year for 10 years into the policy. So all in, $280,000. That buys him a guaranteed death benefit of $1 million. And again, this is lapse protected. After that 10-year premium paying period is up, we're just going to let it sit for 10 years. No new premiums due, not going to make any changes to the policy. During that entire time, that $1 million of life insurance is still in place and protecting Hank. And once we get to year 21, here's where the unique portion of this strategy begins. Hank starts to get all that money back. So in year 21, he gets an income from his life insurance policy in the form of $28,000. No tax due on that. This is Hank's cost basis. This is his premium in. So that is all tax free. Year 22, another $28,000, 23, another $28,000, and so on over the next 10 years. And so in all, Hank is going to get that full $280,000 back. Each year that he is taking that premium payment back, his life insurance death benefit is reducing. And so by the time he gets all of his premium back, what he's going to be left with is $340,000 of tax-free life insurance protection for his heirs, as well as chronic illness protection. So in this strategy, he would be able to utilize 2% of that death benefit per month should he have a chronic illness need. And again, no further premiums due. So we look at this graphically, it kind of helps to see what the policy does. So you can see that during the first 20 years of his policy, Hank has $1 million death benefit. And as he starts to draw that premium back out, you can see the death benefit there starts to reduce over time. And then when we get to age 80, he's left with that benefit we discussed, which is $340,000, continues to age 100, and that is guaranteed. So now we're going to look at the chronic illness benefit. As we discussed earlier, you can see that it's going to provide 2% of the face amount. So in those earlier years when Hank is covered for $1 million, he's going to have access to up to $20,000 per month for chronic illness or long-term care. As the face amount draws down, the chronic illness amount does reduce as well. Again, it's going to come down to about $6,800 per month once his face amount is decreased to $340,000. And that's still a strong monthly benefit, and that can be paired with other chronic illness or long-term care benefits and other policies. But when I look at this, I say essentially you're getting $340,000 of coverage or $6,800 per month for chronic illness at no cost. Now, I do realize that there's the time value of money during the funding and deferral phase of all this, but ultimately, clients all in for $280,000. He gets the full $280,000 back and still has tax-free protection for his heirs and for chronic illness. That is a very unique benefit and something that I think we should be talking about more than we do. This is a unique product solution, so give one of your sales directors at IMS a call if you want to see one of these illustrated for any of your clients. One thing I will note on the strategy as well, the client, if they do want to keep a higher death benefit, you do not have to provide a full return of premium. So in Hank's scenario that we're covering here, if we were only refunding him a premium of $15,000 per year, let's say, instead of $28,000, that's going to keep his death benefit and chronic illness benefits at a higher level. So there's a lot of flexibility here in this concept. So that is going to end the presentation today on our Max strategies. I do want to thank you all for taking the time to attend and for being great partners with us here at IMS. Our sole focus here is to be the support team that you need and you deserve in your business. And we hope that some of these strategies are going to help you to do just that. Give us a call today. Let's talk through any clients or cases you have that might fit one of these strategies, and we'll be happy to put some designs together for you. So you can see here the 800 number is 800-255-5055. You can ask for myself or any of the other sales directors. Appreciate the time and thank you.